Welcome back, everyone, to another explainer. Today, we're doing something a little bit different, but I promise you, it's incredibly useful. We are doing a metaphorical financial unboxing. If you've ever tried to read a mutual fund or ETF prospectus, you already know they can be incredibly dense. Well, today, we've got a 38-page regulatory document, the Scheme Information Document, for the newly proposed Groww Nifty Cement ETF. But don't worry. Instead of you having to wade through all that legal and financial jargon, we're going to unpack the whole shebang right here to figure out exactly how this financial instrument is built.
So let me ask you this right off the bat. Are you looking to add some literal concrete to your portfolio? You know, sector-specific investing always involves a bit of heavy lifting, and it really doesn't get heavier than cement. Let's dive in and see if this is a foundation worth laying.
All right, here's our roadmap for today's unboxing. First, unboxing the Cement ETF. Second, under the hood. Third, meet the fund managers. Fourth, the price tag. And finally, reading the warning label.
Okay, Section 1, unboxing the Cement ETF. Let's find out exactly what this is. Meet the Groww Nifty Cement ETF. This is an open-ended scheme backed by Groww Mutual Fund, and it's officially hitting the market to serve as a highly targeted, sector-specific tool for your portfolio.
Now, what does it mean that this is a passively managed ETF? Well, it means there's absolutely no active stock picking going on here. It is strictly systematic. It's designed to essentially mirror the performance of the Nifty Cement Index TRI. Basically, if the index moves, the ETF follows right along with it. Moving right along to Section 2, under the hood. Let's talk asset allocation. When we look at where your money actually goes, the mandate is incredibly strict. We're talking 95 to 100% of total assets locked directly into the securities of the Nifty Cement Index. The remaining 0 to 5%, that's carved out for debt and money market instruments. So why that tiny 0 to 5% leftover? That's your buffer. It consists of highly liquid assets like G-Secs, T-bills, and repo on government securities. Think of it as the standard operational shock absorber. It just ensures the fund has the liquidity to handle day-to-day cash flows and any redemptions. Section 3. Meet the fund managers. Let's see who's running the machine. Managing all the mechanics behind the scenes, we have Nihil Satam, Akash Chauhan, and Shashi Kumar. Together, they bring a combined 31 years of market experience to the table. They're the ones at the wheel, managing the daily cash flows, executing trades, and working to minimize any deviation from the index itself. All right. On to Section 4, the price tag, costs, and tracking error. This is a big one for any DIY financial planner. The document caps the base expense ratio at a maximum of 0.90%. As with literally any passive instrument, keeping this operational overhead as low as possible is absolutely critical for your net returns. Knowing this hard limit is going to help you accurately model your potential outcomes. But here's a crucial metric you really can't ignore, the tracking error. The fund aims to keep this under 2% annualized. Why does that matter? Because if they drift beyond this limit, you aren't getting the exact Nifty Cements exposure you actually paid for. And finally, Section 5, reading the warning label, understanding the risks. Make no mistake, the Scheme Riskometer officially slaps a very high-risk label right on this product. Because this ETF is concentrated entirely into a single sector, the inherent safety and diversification you get with broader passive index funds just doesn't apply here. So why is it so risky? Well, structurally, the cement industry is wildly cyclical. Demand is intimately tied to the broader economic cycle of infrastructure, real estate project pipelines, and government spending. If interest rates suddenly stifle construction, or if government budgets tighten up, this sector feels it instantly. And on top of that structural risk, you have to factor in the sheer volatility of input costs. Making cement takes a massive amount of energy, specifically coal, petcoke, and bulk power. Geopolitical shocks to global energy prices can aggressively compress profit margins across the entire index before these companies even have a chance to pass those costs on to consumers. And of course, don't forget your standard ETF liquidity risks. During extreme market events, the trading price of these units can temporarily disconnect from the actual underlying net asset value. That fluctuation could force you to buy at a premium or sell at a discount, which is never fun. And that pretty much wraps up our financial unboxing. We've seen exactly how the Groww Nifty Cements ETF is structured, how much it's going to cost you, and the highly cyclical risks involved with its heavy reliance on real estate and energy costs.
So I want to leave you with this final thought to ponder based on your own personal risk appetite. Balancing the potential for concrete returns against these real structural vulnerabilities, is your portfolio ready for some heavy lifting? Thank you so much for joining me for this explainer, and keep learning.